Hello and welcome to Friends That Invest. You're joined by your host Sim. I'm a financial author and investor, and I'm here to help you learn all things investing and personal finance. In this week's episode, we have a very exciting topic, which is what is going on with index funds. You are probably someone that likes to invest, keeps your money there, you're not too worried, you're just dollar cost averaging, and you're going on about your life because there are more important things than to worry about the composition of an index fund until today. News has come out that the index funds that we have come to know and love, like the S&P 500 and the NASDAQ 100, are changing their rules just before the announcement of the IPOs that are coming up, including Elon Musk, SpaceX, Anthropic, and OpenAI. So what does this mean for your portfolio? Should you be changing your index funds? Should you be worried? And overall, is this going to be an issue? I'm going to break down exactly what this means, what you need to do, and if it's something that needs to be a concern, or if we're just going to continue to invest like things are usual. So in chapter 1, we're going to explain what is happening with SpaceX so far. If you have maybe not had the chance to look into it, that is totally normal. Like I said, most people are not like, hey, I wonder how close we are to Mars. I wonder how close Elon Musk is. Like, what is that rocket ship company that Elon Musk started? Where is that going? What's going on? We're busy with other things. Life is getting busy. Some of us have kids. Some of us are trying to get to grad school. Some of us are just day-to-day slogging in our jobs or in our businesses. There are more important things going on. In saying that, SpaceX has decided that they are going to have an IPO, or an initial public offering, on the 12th of June 2026, and they are going to issue what is considered a small number of shares, but what is also a large valuation. And so what I mean by that is SpaceX is going to issue 4.3% of its entire valuation, but the thing to note is that its entire valuation is $1.75 trillion. And so as a result, they are going to issue $75 billion, not even million, $75 billion worth of shares to retail investors on their IPO. And as a result, they want to make $75 billion to continue to fund the growth of SpaceX. Essentially, for investors that have been in the market for a while or understand the jargon behind it, this is quite a small float. A float is just a jargon term of saying how much of the company's entire shares are available for the retail market. So 4.3% is not a lot. However, the issue that people have is not necessarily just the size of the float, but the fact that some of the index funds rules of funds that we have come to know and love, like the NASDAQ 100 and the S&P 500 and a couple of other S&P indices, are going to possibly change just before the IPO happens. And so now let's get into exactly what's going on here. So in chapter 2, in the past, what we have seen is that companies have decided, you know what, I want to IPO. I want to raise more money. Let's do this. And Amazon would be a good example. They IPO'd in 1997, and they were like, this is working for us. This is what we're going to do. Let's IPO. Amazon was a small cap company back then. It was around $500 million, which is now such an embarrassing number for them. But at the time, that's what they were at. When companies wanted to IPO to retail investors, they were growth stocks because, like I said, they were small. Amazon was only a small cap. It had room to grow to become a large cap or a mega large cap. And so if you invested early, or if you had Amazon stock in your index fund, there was room for it to grow even if it took a year before it came on the index. In fact, Amazon is a good example because it didn't make it onto the S&P 500 index fund until 8 years after it IPO'd. What that means is that even though it was on the share market for the first 8 years, there was still so much room for the company's share price to increase that it didn't really matter that it wasn't there at the start. Now, the issue that we are running into nowadays is essentially an issue of too much money existing in the private market. So there's the public market where the S&P 500 is, where everyday retail investors invest. And for the most part, this is your everyday person that's putting money in, they're buying and holding, they're moving on with their lives, they have bigger and better things to do. However, in private markets, like just think of yourself as the owner of SpaceX. We're not going to Elon Musk's mind. Let's just imagine like we're a different founder of SpaceX. And in 2026, you could IPO a company. But the reason why we IPO a company, remember, like, let's go back to Sims Lemonade Stand, is because we need cash to fund the growth of our business. Nowadays, because there is so much private wealth available, the net worth of the extremely wealthy has gotten so large. There is just so much like money lying around. Like when people say, oh, it's hard to get funding, it's hard to get funding if you are a certain person that look a certain way, but it is not hard to get funding if you are also a different looking person with a different background or pedigree, or you've come from, Harvard and you're 22 years old and you're like a boy with a hoodie and you have an idea and you can code. There is a lot of money available for that kind of person. There is so much money available that it's not even the money that these companies are trying to decide on, it's who money is worth more to us. And so they might have like a venture fund be like, hey, we'd love to give you $1 million. And they're like, yeah, well, it's just $1 million. Whereas A16Z, this more prestigious venture fund, wants to give me $1 million and access to its network of like past founders, which include, Mark Zuckerberg or this and that. And therefore I'm going to go with that. Now the issue occurs, imagine you're SpaceX, you want to raise more money. You don't need to go an IPO and get like public cash, because public cash comes with so much more regulation. If I am the owner of SpaceX, every single quarter I have to release like a quarterly form. The SEC has to like interrogate it and make sure that I'm not doing anything illegal. I have to be so careful about like talking about my public shares with my friends and family. I can't talk about like, hey, we have this new release coming out, because then I might be Martha Stewart and end up in jail for like 9 months for possibly insider trading. Like there are just so many more complications. Whereas a private company is treated the exact same way as like a small cafe down the road. It's still just a private company. No one has to see their financials. No one is interrogating them outside of like the general law. And so I guess it's just less headache, in all honesty. And now, because there is so much more private capital available, these large venture funds and large private equity funds and large, like just all these funds available, they're going, you know what? We have like $10 billion and we need to deploy that capital. That's just a fancy way of saying we need to give people cash. Deploy capital just sounds so much more fancier. We just need to give people cash. And so they can give people cash, and as the owner of SpaceX, I'd rather just take that cash and grow the company that way. Only when my company is so large that it's time to IPO, I have now, compared to what companies were doing back in the day, I have now grown to become such a large company. I am a mega cap company, which means that my valuation is so high. I am joining the share market like the NASDAQ or the New York Stock Exchange or the London Stock Exchange. I am joining that at a much larger company size, which means the room for me to grow is not as high between the time that I IPO and the peak of how high my share price can go. That difference is not as high compared to if I was Amazon back in 1997 compared to the peak of Amazon. That is a much higher peak because Amazon was a small cap stock. And now mega cap stocks are coming into IPO. So in simple terms, they're just a little too big compared to what they used to be like. And as a result, in April of 2026, the S&P wrote an 8-page consultation document and asked mega cap companies may pose, I'm going to quote them, may pose unique challenges for index methodologies within the relevant index families. These were originally designed for more conventional listing profiles, like small companies, but mega cap IPOs have the potential to achieve immediate and material investor ownership, trading liquidity, and market relevance. Yet, Adherence to the existing index eligibility rules could prevent such IPOs' timely index inclusion and impact the overall indice's effectiveness as a benchmark. And so they asked for feedback, and they're going to decide. They actually haven't decided. I think at the day of this podcast launching, they will announce if they have decided to go ahead with it. And essentially, they reference like what happened with Tesla. Like, think of Tesla. When Tesla IPO'd in 2020, it wasn't until December of 2020 that Tesla was added to the S&P 500. But because there had been such a delay, the growth of Tesla was missed out by those that were in the index funds. And so the kind of concern that they have is, if these companies do really, really well, should we have to wait 12 months and therefore lose out on these gains when the gains we know are possibly going to be smaller, or should we leave it as it is? That's kind of the questions that the indices were having. So you might be wondering, okay, Sim, that makes sense. We don't want to miss out on gains, but also, like, what has actually changed so far? Because you've kind of mentioned that the S&P 500 or the S&P were thinking of changing. Like, what has changed, what hasn't, where are we at? And at the time of this recording, at the start of June 2026, NASDAQ has changed their ruling. In fact, NASDAQ 100, which is the 100 largest non-financial companies by market cap, has created what's called a fast entry pathway. And this lets new public companies join the NASDAQ 100 before they have maybe met the criteria that they used to have to meet. So, for example, now they will allow companies to join if their market cap is in the top 40 of the NASDAQ 100. So if they're in the top 40 companies out of the 100 large companies, they can be let in. And that just lets them eligible to be let in. It's not like, oh, you're a large company, join in, like red carpet. They're like, okay, you can be eligible. And then on the 7th day of trading from the IPO, so not the first day of the IPO, because as we know, usually when IPOs become available, there is usually an initial drop. So on the 7th day of trading, they will then add it to the index shortly after, and the company must be added on a base of 3 to 5 times the float-based market cap rate, not the total market cap. So remember earlier when I was talking about like float, and I was talking about how only some of the shares available in a company will be available for investors? In SpaceX example, only 4.3% of the company's size is going to be in the float. And so it's a market cap based on how many shares are available. So rather than like, oh, it's going to be valued at $1.75 trillion, that's like way too much money, because it is. Morningstar said the valuation should really be like 700 billion, which is half the size. What we're seeing is that NASDAQ said, look, they can join, but it's not going to be based on the total valuation. It's going to be based on 3 to 5 times the float valuation. So if the float valuation is 75 billion, I'm doing the math in my head, then 5 times 75 billion is $375 billion is what it's going to be valued at. And so when you weigh that up against the total market caps of the other 100 companies, essentially SpaceX inclusion will only be worth like 1% of the overall index. So if you had $100 in the NASDAQ 100, only one of that dollar would go into SpaceX. So it's a very well balanced, in my opinion, way of dealing with it. Now, this has been agreed to. The S&P 500's changes have not been agreed to, but this is what they have proposed. Rather than waiting 12 months before it gets added to the index, it just has to wait 6 months. On top of that, the 4 quadrants of GAAP earnings test is going to be possibly waived, and the minimum float rate, which used to be 10% of shares, is now possibly being removed. Again, the float rate is lower here. So that is a little bit of a concern, but the wait is 6 months, which is still a lot longer than what NASDAQ is doing, which is like, hey, the wait's like 7 days and you're in. So you're probably wondering, well, Sim, that's kind of annoying. Like, they're changing the rules. what does this mean for me as an investor? Which now leads us on to the final chapter of this episode, the pros and cons of this and what it means for you and what you need to do. Let's just start off with the cons, let's be honest. I know that's what we're all here for. We want to know, is this going to disrupt the market? Like, do I need to sell down my S&P 500 shares? Like, this is just another thing to do, another thing to add to the list. My list is like, honestly, never ending. And not to sidetrack, but to kind of sidetrack, I was talking to my mother-in-law the other day, and she was like, Sim, I just like have a calendar in my head. I was like, what do you mean a calendar in your head? She was like, I just know like Ruby's dog appointment is like next Tuesday at 4 p.m. I was like, I cannot live the way you live. I am a woman of the modern age. I need everything in my Google Calendar. But your list is probably just as long. So what do you need to know? What do you need to avoid? The con is that indexes like the S&P 500 and the NASDAQ 100 only can have a certain amount of companies in them. They're kind of like when you go to a pop-up store and only one person is allowed in when someone leaves, or like you go to the club and like it's like, sorry, we have to wait for one person to leave before another person's let in, and you're just like, I literally see empty seats, but that's okay, whatever. That is what happens. So the issue is if something like SpaceX gets added in earlier than it has needed to in the past, it means something has had to be booted out. And usually the thing that had to be booted out has been maybe a profitable company that actually did follow the rules and joined. So that's like not such a great thing to deal with. Another con is that this means investing is not really as passive as we once thought it was. Like, yes, we understand that the S&P 500 is passive and it automatically adjusts, but there is also a board and a committee and decisions made about what can be let in and when. And so to know that the board and the committee are able to adjust things based on what they believe is the right thing to do. And yes, they did, consult with everyday investors, and you could have actually been one of the investors that submitted if you thought this was the right thing or not. There's an active element to it, and it makes investors kind of feel like, so it's not as passive as I truly wanted it to be. And that's, not really what a lot of us signed up to. Now, the pros with this, one is that you do get access to these mega cap companies and therefore the growth of them without having to do anything. And so as a result, it's not going to be like 10% of your portfolio, at least with the NASDAQ version. The S&P version we'll see, but it's going to be a small percentage. And it does mean that if it grows, we're still aiming for that same 7% return over the years. And so hopefully it allows investors to not have missed out on the gains that were seen like when Tesla IPO'd. I remember in 2020, Tesla had IPO'd, so I had my Tesla shares and I also had my S&P 500 funds. And I remember my Tesla shares going up like 400%. And though it was not in the S&P 500, because I had made exposure into that or taken exposure into that, I got the benefit. But then also, shouldn't investors get the chance to decide, hey, do I want to take that risk or do I not, as opposed to it automatically being added in? That's, a concern. Another pro, though, which I'm okay with, is that if the company doesn't do as well, let's say SpaceX IPOs and it drops, then index funds are known, that's the whole passive part of it, they are known to rebalance regularly, and so it will just drop further down on the list and you'll have less exposure to it, or it will completely fall off the list if you're a company that's done really, really, really poorly. So it still has that passive element to it in a way. I also just want to add one of the concerns, and I don't know the answer to this, so I don't really know what this will look like, but one of the concerns investors have, myself included, is will these large companies just add to the Magnificent Seven and be huge movers of the market in the same way that, for example, Nvidia has, or in the same way that Meta used to, where the market moves slightly just because of a few big key movers. And because of the large market cap, is that going to happen? Now, at the end of the day, it is so hard to predict. And there is, in my opinion, no point trying to time the market and sell down your shares before the IPO and then rebuy them if it makes sense. I am personally going to just stick to dollar cost averaging in my index funds. And if there is an IPO of a company that I'm interested in, then I'm going to do my due diligence. I'm going to wait it out for like at least 6 months and then I'll reassess. But other than that, you're doing the right thing. You don't have to change your investment portfolio. Even though some of these rules might change in terms of how index funds work, they are always going to constantly change. And honestly, you know that really cheesy saying that the only constant is change? I guess that's just something that applies in index fund investing as well. I hope you enjoyed this episode. I hope you found it helpful to learn what has changed, the problem with private markets versus public markets, and what's going on with SpaceX. And if you found this episode helpful, then please take a screenshot, put it on your Instagram story, tag friends that invest. It is the best way for us to grow the podcast and reach more people. And what more can we ask for than more women that know about financial literacy and investing? So with that, I'll see you next week.